Good morning. This is the IFB session on designing portfolios for investment and nature returns. This is the fourth session in our series so far, and we are very happy to have you all join us. I'm going to provide you a couple of minutes on the IFB, and then we'll just roll right in. So IFB got started about 18 years ago by Audrey, who is on this call. Just a handful of people around a table. We are now at over 6,000 members, 50 chapters, 49 of them are local, so in cities around the world. And the 50th one is this chapter, which is the global chapter. So we are hosting this event as part of our series on investing in nature, nature as infrastructure. We use plastics as the investment case. We've been walking with Joe and Hari for a few weeks now, and I'm really grateful for that because two of my favorite people, really happy to be here. I am going to be, my 1 year is up as the head of Impact for Breakfast. So this might very well be my last session. So really happy to be sharing it with all of you. Thank you. And with that, I'll just hand it over maybe to Hari to recap how we've walked together.
Thank you so much, Kayvon. And yeah, very grateful to be here with Joseph and with all of you. So this is the fourth in a series here. We've been talking about systemic investing using nature as a backdrop and a specific case around plastics. Today we're going to continue that journey and then broaden it out a little bit across kind of the natural capital spectrum. Kayvon mentioned nature as infrastructure. I'll talk a little bit about what we're building in that realm to reconnect sort of our relationship with nature, but also think about investability in natural capital and nature as infrastructure as a grounding for the global economy and through a systemic lens. Um, Joseph will be talking about a systemic approach to investing in the plastics transition, which builds from the previous three sessions as well. Many of you have been on them. Otherwise, if not, you can catch up through the YouTube channel and videos. Kayvon and the team will be sending those around, I think, to everybody on this call. But just as a quick recap, where we started was a session talking about investing, where Joseph laid out kind of the systemic investing case with plastics as an example, and really breaking down the notion that we need to think about everything from a siloed asset class approach and think more about cross value chains and across kind of the systemic architecture that's necessary for transition. The second session, then we went kind of into the weeds around some of the plastics issues, specifically around microplastics and the human health and environmental health challenges that microplastics at the end of life of the plastics kind of value chain pose on the planet and what costs those impose. We also talked a little bit about transition of plastics to reduce the load of microplastics in the environment that then lead onward to human health and environmental health dynamics. We touched a little bit on beyond just plastics and nature, the cost to society as well, and how addressing this challenge is fundamental to addressing sort of the overall cost basis of how we deal with, human longevity and human flourishing on the planet. We then moved in the third session to talk about sort of upstream in the value chain and where we can think about solutions at specific points in the plastics value chain that address the front end or input side of the environmental challenges as well as the output side at the back end of plastics value chains. And we heard from a few companies in sessions 2 and 3 that are emerging either in seed stage or through growth stage that are addressing specific problems across the value chain. Those examples provided us sort of specific points of intervention, potential investment, and partnership and collaboration, but couched within this whole notion that we can't address these things from an individual entity perspective. It has to be thought of in a systemic way, which is boldly ambitious and large in scale, but necessary to have a transition that makes sense. Today, as I said, we'll be talking a little bit more about the complexity of systems thinking, but the importance of it. So we'll spend the first few minutes, Joseph and I, in a little dialogue around complexity thinking, how we can simplify complexity. So one of the things that I talk about a lot is that we often think that something that's complex is hard and difficult and complicated, and the opposite of that is simple. So we can't have complexity and simplicity at the same time. The notion that I'd like to convey here is that the opposite of complexity is actually uniformity. So you can have something that's complex and simple at the same time, but you can't address complexity with uniform approaches. So individual siloed approaches or asset class approaches can't influence or can't fundamentally shift systems that are complex. And nature and plastics and some of these large value chains are inherently complex, but we can simplify them so that we can approach them systemically and address them. In reality, the opposite of simple is complicated. And what we often are challenged by is making complex issues very complicated so people don't understand them. So part of the notion of these four-part series and all of us talking together is to redefine how we can make complexity less complicated and make complexity simple for us to approach, wrap our hands around, and then move forward and address systems change. Then we'll move into a conversation, or Joseph will present sort of what he's doing in terms of addressing the complexity of the plastics transition in a simplified investment thesis. And I'll talk a little bit about what we're doing at the global level to address the nature funding gap, which to me is the most complex challenge in the world because it's ecosystem dynamics across the globe. However, we've stratified and simplified kind of the notion of commercial pathways to address the global funding gap within global frameworks like the Biodiversity Convention and pathways addressed in the Paulson Report and the Descriptor Review, which I'll talk about a little bit more. We'd like to leave ample time for discussion because the the strength of a conversation like this is not hearing from one or two individuals. It's from the group talking about how we all think about systems, how we all think about complexity, how we're all approaching it. So we'd love to leave ample time for discussion, questions, inputs, everything else. And as I say at the beginning of all of these conversations, um, this is Impact for Breakfast. Uh, we may or may not be eating. I have a cup of coffee beside me, but no meal is free. So if you're on mute or if you're off video, you're still not safe. So we'll draw on you. I'll ask questions. I'm going to solicit feedback. The strength of this, like I said, is in all of us collectively thinking about system solutions. And those of you that have been on these calls before, you're fairly warned that you will be asked to contribute. So just giving fair warning to everyone else. So let us begin with Joseph. I'd love to ask you how you think about complexity, how you think about systems, and just set the stage for, this conversation around, complex systems design and how to simplify that and stratify in a way that makes sense to wrap our heads and arms around.
Absolutely. Thanks so much, Harry. It's great to see you, and thanks everyone for joining. I fully echo what you're reflecting in terms of complexity isn't necessarily complex. It just means an appreciation for a different way of combining things. Keivan, you just mentioned the really interesting call IFB held yesterday on AI and the human aspect. And one reflection I had is that if you take complexity and what AI is allowing us to do, not just to do things better, faster, cheaper, but allows us to do things differently, that creates an opportunity where complexity can be addressed when previously it couldn't. And many of the operating models we've had, whether it's an asset class specific, a function specific, consultant, public sector, or any other silo of society, or a science specific aspect, AI doesn't replace anyone in those areas anywhere near as much as they would be able to do themselves. But to get us closer to how do we combine various disciplines and go cross silo, whether it's in people's careers or in the solutions we need. And that's massive opportunity because it allows us to go multi-stakeholder, multi-sector, multi-solution, and achieve those trifecta. And we'll demonstrate that today, just with tangible example. I mean, what Harry and I wanted to do in this session effectively is use plastics as a worked example to make a more general point about how investment processes need to evolve when the problem is systemic. The plastics transition in this case, it's the method is what travels, and how to illustrate that and to extrapolate from the comments we'll share later on to make it tangible, but how that can translate to various solutions and how we look at systemic investing 2.0, whereby we can actually use complexity to reframe investments on par with all of the other enablers, which is what investing always should have been, not just an extractive industry of risk-adjusted returns for capital preservation, but investing as a verb. And I think that that's the true value of complexity, where we allow it to be a conduit to achieving outcomes. And we'll discuss that later on in terms of how that allows us to invert the investment process and think about outcomes first. And yes, if we look at things just in a single silo, we will have God knows how many working groups and NGOs trying to struggle with how do we make XYZ investable. Nature is one of the biggest conundrums as we see, especially when it comes to oceans. SIDS in particular is probably the biggest dichotomy between what global ecosystem services are provided versus what the financial sector will make responsible. So answering your question, complexity, I think, is necessary. AI allows us to tackle it properly and recreating not just the way we collaborate and go cross silo, but in terms of how we rethink solutions and reinvent in more simplistic terms. I mean, as you said, it's not necessarily complicated. How can I have a simple, elegant solution that embraces it and actually achieves the goal of systemic shifts?
No, thanks for that, Joseph. And just adding to that, I think the fact that we had at IFB a conversation on AI yesterday and how you brought that in, Joseph, is really telling. And I love what you said about the spaces in between, right? AI now allows us with much more data integrity and fidelity. If we have synthesis and analysis functions on top, allows us to play in those spaces in between, cross-sector, cross-stakeholder collaboration, cross disciplines, all of those kinds of things. But it's an evolution of what's been happening already. So 13 years ago, I started a consulting firm to play in those spaces in between. And what we found is that, if you play with one sector, you can have limited impact, but it tends to be subscale and it tends to be constrained. When you play in between sectors and can drive stakeholder solutions, you can leverage a considerable amount more. And what we found is that we've been able to leverage a significant amount. Over 13 years, we've been able to leverage nearly $6.5 billion towards the sustainability transition. And much of that capital is new and wouldn't have come to the table on their own as individual entities or individual industries. It's because of that collaboration and translation in between that we were able to make that happen. And the exciting thing now is that with the flourishing of data and AI and capabilities, we can fast track that and leverage and exponentially grow the spaces in between so we can drive more systemic change and impact. I'd like to move a little bit now into more practical examples. So you've been developing a thesis around the plastics transition using a systemic lens. Tell us a little bit about Calmus Capital, your journey to get to where you are today, and what's happening as you go forward, and how Calmus is trying to address this issue. And I'm going to constrain you with about sort of 10 minutes, so that's a lot of various questions to get through, but I know that you're in a position to do.
Thanks so much. And yes, I mean, my career historically has been in actually within the alternative space, so in institutional hedge funds, fund of funds. I used to run UBS's hedge fund investment platform. But for the last 18 years, it's been in parallel. How do we mobilize the plumbing of finance and the incentive structures there to scale up impact in different ways? And the way I'd summarize it is basically saying we've operated in a black and white risk return movie. So in black and white world, when you want to move to color, as we did in 1940s, red, blue, and green, you put them together. It's a different lens through which you see everything, and that, as we said earlier, requires complexity. So to set out Calmus, and actually Calmus is named after the MIT professor that created three-strip photography and founded Technicolor to take us into the world from black and white to color movies. So it's very much at the ethos as an investment advisory and designing funds or solutions but outcome first and working backwards with our own investment process. And the journey towards this fund that we're designing and launching in the plastic transition came about actually, funny story, it was sort of with the co-chair of the Business Coalition for the Plastics Treaty. We're negotiating the Plastics Treaty and discussing in terms of how do we get the Saudis to keep the oil in the ground? How do we actually shift the end solution and bring an investment lens, not and realizing that a lot of what we've done is historically taken impact color palette to the investment industry, as opposed to taking the investment tool set to what we need to do in impact in nature, and actually how do we remobilize things. So, and it effectively developed into a thesis, which was just first principles thinking, which we do and apply that hedge fund mindset of first principles, third derivative of what the solution needs to be, where's the market today, and what's the catalyst to change it, and really focus on what is the financial narrative that is convincing, not just for us, but for what the pricing mechanism is, to get that theory of change. Not because we're aspiring to theory of change from an impact perspective, but what is going to make that change. And develop the thesis. I'll share a few slides to describe that, but effectively it does boil down to addressing first what the main systemic problem is, and then working backwards. And I won't spend too much time on what the actual nature of the problem is. I think everyone here is more than aware of the 400 million tons of plastic that's being used and how it's predominantly packaging and single-use plastics. Essentially, we need it. Plastics is a good thing. Food is preserved and climate is better off with plastics than it isn't. It's a huge market and there's a lot of growth. I mean, it's tripling in growth, and but it is a marginally at the margin. It's sort of the fastest growing revenue. Actually, it's the majority of the revenue growth for most of the oil and gas companies. It'll probably be one of the largest sources of emissions. And so a solution is needed, and going through first principles and discussing it mainly, and that's the benefit of being in Geneva, sort of close to the UN ecosystem, and understanding sort of where the policy shifts need to go, and benefiting from all of the talent here is bridging that gap and that white space that you mentioned. And working backwards to the solution and saying, well, how do we get there? And what are all of the possible solutions before we landed on seaweed and the blue economy, and why this, and to focus and to rethink working backwards on how do we design the investment solutions for that. We discussed on the first session the thesis in terms of why business as usual is not going to be possible, and the CBAM thesis and the trigger that CBAM as a carbon border adjustment mechanism will change the pricing. That was before the Straits of Hormuz and doubling of price of existing plastic. So that accelerated. And then working through the various alternative positions that any of the large players across the low margin, high leverage value chain, from the petrochem exporters to the packaging companies to the FMCG and retailers, all of which are huge operations, and to understand where's the puck going to go, what are they going to be needing to shift to, and we've seen this movie before. But where it's different when we look at it from a systemic investing, and going back to the point that you mentioned on complexity, we need to have a different evaluation criteria when we look at things systemically than just on an entity level. And when we look at it systemically, what could be annoying but manageable when looking at one particular solution today on an entity basis, all of which are very viable, on a systemic basis, it's not going to get us there. And if we're going to be focused on how do we actually have a theory of change on a systemic basis, we just came to the conclusion that scaling seaweed on a global massive scale is the highest probability outcome that is inevitable from a deductive reasoning perspective. And so we just kept doubling down in terms of, well, what does this mean? What is the problem and why isn't it there yet? Well, it's fragmented. The unit economics might not make sense. And we described that on this third session when we had upstream, downstream, and midstream players who on their own might, if an investor just goes into any one of them, might see it as, well, its impact and why the returns will take longer, and it is infrastructure and there's different sectors that come in. But when you plug them in together, you need to have that systemic orchestration to trigger that change. And going back to what we mentioned earlier in terms of the AI and complexity gives opportunity, and you sort of have multi outcomes. That's where you we realized that you following the financial incentive structures allows us to identify the opportunity to scale the blue economy and nature investing, but by weaving that financial narrative. And so understanding that with bioplastics and all the different alternatives, that there's always going to be fragmentation. But the reason we focused on seaweed is very much because of the scalability potential. And the solution we landed on was saying that, well, we need to rethink the design of the investment process we generally have and design it as the portfolio construction being the impact by building out that value chain. So identifying all of the different seaweed upstream producers, whether it's by scaling up the sargassum value chain and you driving unit economics down because, well, free is you can't beat free. So how do you get it from the different scientific processes and what you need to do to scale the sargassum, or whether it's the coral triangle where the unit economics can be squeezed down because of, well, you've got the massive food industry and to build on Indonesia in particular, which is historically the Silicon Valley of seaweed, with large surface area of shallow waters, with cheap labor costs, with scalable maritime and policy tailwinds, as well as all of the innovations on taking a fraction of what we've evolved with in ag tech and applying it to aquaculture and farming seaweed and different types of species. And that's a different business model to identifying the right technologies and converters and extraction technologies. And it gets quite complex, and we can go into it if anyone's got questions later. But then also, how does that compare to the different business models in terms of bioplastic conversions? And we had Nopla, which is a great success story on the third session, sort of unpacking their approach and scaling sort of the seaweed alternative to packaging solutions there. But why complexity is needed is because, well, if we're looking at how do we build a portfolio where on a look-through basis, we're purely dogmatically focused on the one outcome we want to achieve. Yes, on an ex-post perspective, we end up with what investors would require in terms of diversification regionally across different business models, different stages. And we can reshift the way that we have the building blocks that we used to in the investment space, because we want to be able to say, well, no, we are focused on achieving that one outcome, even if anyone's report looks with the diversification that we require. But it's also respectful of the stages of the industry. So we're still up there on the cost curve. So most of the products and services are going to be on higher margin, not plastic use, especially upstream. So biostimulants is massive and growing. And yes, fertilizer prices going through the roof also helps. But if you're and helps accelerate the opportunity for biostimulants and other nutraceuticals and food additives. But it's a question of identifying the companies that would have that pathway where you can monetize early and use the cash flow and how that evolves, and focusing on companies that can do what they do it well and not try and do everything. So yes, there's all of the other multi-use and great growth we're seeing in pharma, agriculture, and actually UNCTAD mentioned that sort of for the last 3-4 years, even from a small base, non-food global trade of seaweed and it's probably the fastest growing category in triple digits. But then also, if we think of the investment process just as looking at for solutions to an outcome, not just a collection of impactful companies aligned to an outcome. That changes the investment process from the very beginning. Why we're looking, how we're sourcing, what we're integrating into the due diligence. How do we leverage AI to go to look for the right patents to then back into the companies and then recalibrate the way that you look at the due diligence criteria and weights for the different companies, because you're looking for what is their role in that value chain and how can we use it? How do we plug it in? How do we actually have more of a partnership role with the companies? Not because it's a question of value creation after investing and on a business perspective, as would be diversified across different companies. No, it's by being very narrow in terms of the field of expertise, assembling the talent pool that would be enablers to plug them in with the right JVs, with the right licensing agreements, orchestrating the offtakes that can go through the value chain, identifying the different species that need to be compatible across the value chain, and embracing that complexity, because the portfolio approach needs to be the driver of the impact, which is also where you unlock the financial returns. And so marrying the various attributes, but just reordering them allows for an elegant, I'm not going to go as far as saying simple solution. First time approach to anything is never going to be simple, but it does provide a different approach to how do we stay on track and match the time horizon that we're investing in with what the systemic nature of what we're trying to achieve in. And rather than take that, sorry, I'll just land on this. We are on one side of the Rubik's Cube, we're doing our bit and contributing to something that everyone else has their color alongside. It's a question of leveraging AI to understand the nuances on all of the different other attributes, to think about how you design the entire solution from the outset, and then work backwards towards building it and rethink every single step of the process, from the screening all the way to the choice of LPs for those that can bring more than just capital because they're part of that value chain and can contribute offtakes as well as expertise. And so rethink the partnership in terms of how do we not just solve for 5 sides and then of a Rubik's Cube and then figure out we need to start from square one because everyone's incrementally going across their silo, but leverage AI to get to the granular detail and the complexity, and then just bring it back to what are the actual solution we need to get to solve it and bring it together.
Thanks, Joseph. You did a great job describing kind of the how, and I liked how you brought in some of the components from the previous sessions. And there's more. For those of you that were here for the previous 3 sessions, there's a lot of what Joseph said that ties together a lot of what we heard from individual companies from before and otherwise. One thing that really stuck to me is that you said you wouldn't say simple, and I agree with that. When you start and try something new, it's rarely simple. The word I would use here, though, is structured. When we heard you talk about sort of the how, it's very systematic in how you're thinking about this approach, and it's structured in a way that you can leverage tools like AI and other things to answer questions. I think one of the challenges that we have in complexity is often we just think everything is kind of there and random, and then we get scared. But if we can structure the complexity in a way that we can start to ask and answer some questions, then it becomes more simple to move forward. So the how is very well articulated. I'd like maybe 2 more minutes, Joseph, and just talk a little bit about the what. So you talked about Calmas, where it came from, the idea, the how you're thinking about it, diligence, complexity, the multidimensional approach and partnerships. What exactly are you doing today, and what do you want to be doing 6 months, 9 months from now? And how is this going to move forward? To the point of, you know, I love talking about these things from a theoretical perspective, but what I love even more is getting capital flowing to think solutions to address systemic change. And the other thing that you said that I just want to pick up on is that, a shift in as we think about systemic investing is, rather than taking an impact lens to the traditional form of investing, we need to start thinking about impact solutions and then the tool set of investment products that can apply. And it's a very different way. It's kind of flipping everything on its head. So rather than thinking about the tool and how to apply it and then building bells and whistles of impact and ESG around it, and this goes for operating companies as well as investment strategies, it's flipping it on its head and asking the question of how do we change a system? What's necessary to get there? And really focusing in on the fact that not all of the pathways are going to be, profitable and revenue generating, but how do we stack the right partners, stakeholders, investment strategies, nonprofit philanthropy, concessionary, and commercial capital together in a way that drives forward so we can get that systemic solution and outcome. So what are you doing now? What do you want to be doing? How do we get money deployed? And how do we change this system?
Spot on, and thanks so much for that. And I'll be very brief on what we're doing, but then I'd love to take a whole minute to describe the last point you mentioned in terms of how do we flip this upside down and the approach. But yes, effectively, as a first time fund VC doing a 50 million flexible multi-asset, multi-stage fund, just purely focused on this one thematic. What we're trying to expand from that is to think about it in terms of multi-asset, not just to be a VC fund with where investors are buying into just a skill set, but then how that combines with having the blended finance vehicles that combine with first loss uh, provisions for these seaweed farmers for working capital and accelerating that. How does that combine with whether it's blue bond or transition bonds or infrastructure spending for the capex required for the for the downstream conversions plugging in with the manufacturers and the existing industry. The objective is about working backwards, as I'll go into, but effectively what we're doing and starting off with here is just effectively designing an investment solution as a fund, as a just classical first-time VC fund targeting the first close towards Q3, Q4, and at a 50 with a cap at 75, which will focus effectively on that value chain that I've mentioned. We've got about 11 portfolio companies that we're ready to go and diligencing and actively focused on, but we've leveraged AI to come up with a pretty unique screening and deal flow process that I'll describe after I go through the slide, that really leverages AI in terms of being forensic in how we search for the right solutions and therefore back into the companies. Where we'd like to be is sort of just demonstrating a different approach to investing that's not just cutting margins and costs because we do what we've already done better, faster, cheaper, and sort of screen more companies to be even more restrictive. No, it's a dynamic process across the scale, but then we're also trying to be flexible in how we think about asset classes as enablers. And this goes back to sort of my background in terms of the cross-asset investment approach and alternatives, is that different asset classes isn't just an exposure and a single materiality perspective that gives you a different risk return profile. No, they're different enablers with different transmission mechanisms. And it's a question of being flexible in how we leverage those transmission mechanisms across asset classes to just coordinate, not just asset classes, actually different silos, whether it's consulting or policies and also science, to just focus on having one outcome achieved and bring them all together around one particular outcome. And that helps a lot. So but I'm going back to your question in terms of flipping it upside down. Yes, here on the left, it's describing the existing process that we take for granted, or asset allocation at the top level, and you can have a private equity and expect and sort of have very increasingly absurd capital market expectations of what we expect from an asset class, and then filter it down from that. And I won't go into all the flaws that we have with the existing system that we just accept and take for granted. But if we just say, well, here's your asset allocation, it's an asset class, and here's a talent pool of experts, and then here's a universe, and then we cheat a bit to have a bit more diversification, then have the financials first, then look at the impact and the ESG and then all the reporting, and have a portfolio of different outcomes. And it's and we think we're going to scale impact by having different pools of capital, which are Trojan ponies, as opposed to having a Trojan horse, which is let's just focus first on the outcome. What is the high priority, unavoidable outcome we need to fix? We can't. There is no solution for this not to be addressed, which underpins the returns narrative. Then work backwards. What are the transmission mechanisms? Then work backwards. What are the incentive structures? Then work backwards to where are the bottlenecks. Then you get to, okay, what are the solutions? If it's a bunch of companies and they happen to be in the early stage, then it's a VC. This is what's required. Then we understand and come up with what's the Rubik's Cube solution. Get the right species, get the right combination of technologies to get from A to B and actually plug that in. Is it the VC model, which we think is a label, which means take the Y Combinator, spray and pray, and hope that one of them will be the Tesla that replaces Ford, as opposed to these are solutions that need capital and support to take that solution and plug it in to change the existing value chain. On a systemic level, it's far more economic. Go as far upstream as you can, be as wide as you can in terms of seaweed species compatibility, be as wide as you can in terms of different performance requirements of different types of very complex plastics, and optimize for that, and just scale and plug them in. So the value creation ends up being how you put those together, and then work backwards to what is the talent stack you need? How do we go and identify the right people for that particular solution that we've identified at the portfolio level? So Bernd, for example, spent 25 years at Nestle, in different roles in R&D and packaging and heading up packaging in Germany, and will be very well suited at the right time, at the right place for the right companies, not just to guide them, but then how to attract them, how to support them, and how to plug them into the system in that respect. Same thing with how we identify the talent pool of partners and stakeholders, whether they're on the advisory boards or on a broader basis, not because NGO X sounds good on a slide deck, but because David and Henrique at UNCTAD have done amazing work in looking at all the different bioplastic alternatives and really focusing on that. And that's a great conduit for how we leverage those capabilities. How ITC are doing phenomenal work in looking at supporting the entire sargassum value chain and using public sector money for that. And then work backwards towards adapting the investment process and diligence there, and how we come up with a different sourcing and approach for that. So yes, that's the USP or design, but it also goes into how we're looking at it on a vertical circularity perspective. How do we not think of the traditional asset management model where you've got a separate marketing and fundraising department that'll just take product and push it to investors that are there saying, well, it's got my asset allocation expectations and a nice outcome and story and thematic, as opposed to what a lot of investors want, which is we need you. Here's why we need in this particular investor, because they're linked to a operating company within that value chain. I mean, Lego, for example, not that they're investors are speaking with a bit, but I mean, they've probably got the highest percentage of costs that's linked to plastics. They've got all of the experts in the world that I couldn't dream of putting together onto an advisory board. They've identified 600 solutions, committed to 50% of their bricks being plastic, fossil fuel free, expected to be 70% more on their costs, and committed to having that on them, taking into their margins. Great. If they also want to invest, I'd love to talk to them. But my first port of call is say, okay, well, how do we make the solution the actual catalyst that
Yep.
unlocks all of the trifecta of things we're working towards. So
Thanks, Joseph.
few different
I,
organizations. Thanks.
I really like how we'll come back to some of this and we can address some of this in questions. I'm going to transition a little bit here, but I just want to pull out what you said at the end there, which is a theme that's come through in the four sessions and one that I think we really need to double down on, which is how do we think about things solutions first rather than mechanism or product or intervention first. And I think that's the fundamental shift that you're talking about, flipping the pyramid. Um, I'm gonna broaden the story out a little bit now and talk beyond plastics into nature, which is kind of the focus that I'm building around at the moment. And I'm gonna tell a story and take you on a bit of a journey in the group that's gonna maybe sound slightly different than how Joseph broke everything down, but hopefully we get to a similar place and it sparks some conversation and discussion. So just a bit of background around me is I'm the most unlikely entrepreneur, um, consultant, and investor you'll ever meet because I really don't care how we get to the solution. I'm very, very focused on the solution around the environmental transition that we need, sustainability transition. So where I started with that journey was as a tropical marine conservationist, then working for nonprofits. And where I've come to is recognizing that there's not enough money in the philanthropic world or the public sector to drive the scale of change necessary and the capital flows necessary to get to the solutions that we need. So I'm a very reluctant private sector person, but I'm conscious of the fact that we need the private sector engaged at scale in order for us to get to the transition points that we need and the scale that we need. And what that means is that we have to conform sort of the aspirations for solutions and systemic change with the realities of how the private sector operationally and investment wise works. And that's what we've been building around for the last 15 years and beyond. I also want to address a comment, Joanna. It's a brilliant comment that you made on the side about a half an hour ago, which is around complexity being a driver of the resilience for nature. So a couple of the way you phrased your comment is really what I take from that is when you say the challenge for complex systems oriented around harmful principles, and you talk about capitalism here, growth, profit at all costs, the perversion of capitalist structures, is that they are very resilient to change. So what I draw from that is the assessment that nature as the foundational, most complex and beautiful system that we have is inherently resilient because of that complexity. So no matter how much we damage it, we don't see it immediately because the resilience function goes on. Now we're seeing cracks in that now because we're breaking it down, but there's a long-term lag between all the pressures we put on natural systems and how it manifests and bites us back. And that lag is much farther beyond political cycles, sometimes generational cycles. So the people benefiting from the extraction don't see the results, and they don't really care if their kids and grandkids see those results from a time like a human time perspective. Now, when you explain what's happening to future generations, people sometimes come around and see that. But the flip side of that complexity leading to resilience is the opportunity set that we have today, which is that if nature is the most complex and beautiful system that we have and inherently has resilience, then it can underpin resilience across other functions that we put on top of it, other structures like the global economic system. And today, the first 4 months of this year is a classic and prime example of how in more stable underpinning systems, we have less volatility in capital markets. I mean, if you're looking at capital markets right now and the volatility in the markets, that's due to sort of the resilience function being compromised in large part. So the story of how we're building around sort of commercializing and building a commercial pathway to nature really started about 2.5 years ago um, in the context of what we're building. So 2.5 years ago in Dubai. Oh, and just another quick point is so the journey that I took through the nonprofit sector and realizing there wasn't enough money in the nonprofit sector and the public sector uh, gave me exposure to a lot of other things as well. So these global treaties, the Convention on Climate Change, the Convention on Biodiversity, framing the challenge, and then in the last 5 to 10 years, we've had a lot more work on setting targets around what's needed from the solution basis. So the Paris Agreement in 2015 gave us a target for the climate crisis. And the Kunming Montreal commitment in 2022 gave us the biodiversity framework and the 30 by 30 goal for nature. So we have better framing now than we did 20 years ago when I started my career. And we also have pathways that have been identified. So the biodiversity framework to get to 30 by 30 has 178 targets and pathways underneath, distilled and itemized. We have other work from, the Paulson Report and Dasgupta Review and others that talk about how we cost out those pathways. And then we have, smart people around the world looking at those pathways, costing them out, and seeing if there's revenue drivers that can drive, business decisions or what forms of capital can go towards those. The challenge now is to consolidate that into a functional pathway to drive capital allocation and drive that systemic change. So the story of what we're building started, like I said, 2.5 years ago in Dubai at the climate convention, and there was a dinner at Goals House where a senior representative of Conservation International, Patricia Zurita, stood up and talked about the nature funding gap. Because we have that data now, we can talk about it. And much of the world doesn't realize exactly what the nature funding gap is and how we need to reconcile our relationship to get to 30 by 30. And the number from the Paulson Report in 2020 is $711 billion. Now, there's other estimates that scale that up a little bit, but we now know that there's somewhere between 700 billion and 1.5 trillion dollars of new capital required to address the nature funding gap. And that nature funding gap to achieve 30 by 30 is quite simple. We need to protect 30% of critical habitat. We need to restore 30% of the habitats around the world that we've degraded as humans over the last hundreds of years. And then we need to think about, pathways to sustainably manage the rest via more sustainable forms of agriculture, timberland, fisheries, and extraction. And that gets us to our 30 by 30 target. And we need to do all of this by 2030 to have a reasonable pathway to reconcile our relationship with nature. The other thing that we know is that, to your point, Joanna, nature is complex and underpins resilience. The PwC report that came out in 2022 talks about the amount of the global economy that relies on nature as its fundamental asset base. And I would say, very conservatively estimates that it's at least half of global GDP. I would argue that the entirety of global GDP And the entirety of our human existence relies on nature as an underpinning resilient asset base. So nature's infrastructure is not only important for, parts of the economy, it's important for our existence, and our existence is required for the economy to exist. So nature as infrastructure, nature as fundamental and resilient is critical for everything. So in that room, Patricia mentioned these numbers, and one of the founders of Goals House, who's a colleague of mine now, Gail Galley, kind of threw up her arms and said, "Oh my goodness, I didn't realize it was that bad. $700 billion is a lot of money, and we are screwed." Um, and next to her was sitting Jay Littman. And Jay is a co-founder of Ethic, one of the largest environment or ethical registered investment advisory firms in the US. And they manage 7+ billion today. And Jay kind of looked at her and said, "Look, I deal with institutional investors all the time, and 700 billion is less than 1% of global GDP. Like that's not actually that much." So we all got together then and said, well, okay, if that's the case, it's a big number, but not that big. And in fact, that 700 billion, what we also know is that part of the solution is going to be reform public allocations. So 2/3 of that challenge is actually a subsidies problem. So subsidies reform is going to drive a lot of the change. So the remaining gap for private investors and capital markets is 200 to 400 billion. So it's much less than 1% of the flows of capital through the global economy on an annual basis. So we got together and said, well, so is there a way to address this? Are institutions looking at this, concerned about this, and willing to do something? And in conversation with the pension funds, sovereigns, multi-generational families, we heard time and time again that they were looking at this and interested, but they didn't know how to functionally move forward. So fast forward to today, and what we've done is built two entities. The first entity is to tell the story. Because while we all rely on nature for our fundamental existence, every single one of us, even those of us that are working on nature every single day, take it for granted. So, what do we do about things that are important that we all take for granted? Well, we need to publicize them. So, last year we launched the NAT, which is Nature's Publicist. And rather than screaming from the rooftops from scientists and policymakers saying that nature is important, rather than listening, which we all should, to Johann Rockström and the planetary boundaries, what we said is, how do we insidiously install this into culture? How do we use the biggest influencers in the world and the celebrities and the athletes that all the children that we have and all the people around us, are drawn to, listen to, have huge networks? And how do we convey that story of nature as critical and foundational and core infrastructure so that it gets out into the world to everybody? And that's where the NAT was born. We came out in the world in London at London Climate Action Week, but we really, really came to the world by hosting and mimicking what the Met does every spring, the Met Gala, and hosted the inaugural Nat Gala in the fall on the eve of Climate Week in New York last year, with celebrities and athletes and influencers and musicians to talk about their connection to nature and the value of nature. We also brought nature heroes in the oceans, on land, indigenous warriors to tell their stories about why nature is critical. And it was a successful event and a moment, and it's spawned sort of a movement to do more. So we have events all through this year. We'll be doing the gala again in New York this fall, and it'll be an annual event with that power of celebrity, with that flash and sizzle of kind of the Met Gala fashion, celebrity influence, all of those things. And that's very exciting. But culture alone and awareness doesn't drive funding the 200 to 400 billion that we need. So this year, what we've been doing is formulating the largest commercial vehicle to drive capital towards nature and addressing that funding gap. But to consolidate these disparate things with what Joseph talked about, that solutions lens. So we know that there are pathways to go using these frameworks at the global level, at national levels, NDCs, all of these things that we've worked on for years, and our partners have as well. But now it's a matter of consolidating those into pathways where we can direct capital on the ground. And the great thing is we also have examples. So what is really apparent, and the flip side of what you talk about, Jana, in your note, is that while nature is resilient and doesn't show kind of its scars until too late, it's also foundational and drives commodity cash flows and infrastructure returns and annuity returns in places. And what we've been able to demonstrate is in specific landscapes, we can actually show that to be true. So we have pilots now where we've deployed a notion of the biodiversity framework in a micro scale, so conservation, restoration, sustainable land management, to drive cash flows and returns that are mutually reinforcing so everything works. So if you look at those buckets more closely, conservation and restoration are hard to monetize from a recurring cash flow perspective. There are voluntary markets. There are ways to monetize certain aspects of it. They're highly volatile because they're voluntary, carbon markets, biodiversity credit markets, those kinds of things. But it requires sort of investment. So what we've said in these landscapes is we have investors that are interested in doing those things because they think it's the right thing to do and maintain these landscapes. But the argument that we've conveyed and is gaining traction is that that provides the underpinning infrastructure and resilience for other investments that you use in that third bucket, which is sustainable land management, to drive continuous cash flows around that, which are more stable, which are more guaranteed. We can link to off-takers on the other side, and those are stable, regulated cash flows through infrastructure, through energy, through water, through agriculture, through timberlands, through tourism, and the list goes on and on. So rather than thinking about a landscape with the lens of I'm an agriculture investor or a real assets investor, I'm going to do real assets everywhere. We look at a landscape and say, what is the ecological value? What's the uplift potential that provides a more stable base of infrastructure? What is that going to cost? Recognizing that much of that cost is going to be CapEx in with that revenue out. And then how do we layer nature aligned cash flows in a more regulated way that can drive the returns, that can facilitate that whole of landscape approach or that systemic approach? The example that we're building off of is very large, 1 million acres with over $1 billion invested, generating gross returns that kick off into public good to service that piece that I talked about before, where philanthropy and public budgets can't support it. These are being supported by residual private returns. And then the residual net returns to investors are still double digits. And what happens is that we break down this case, which is that, you know, the challenge for conservation and nature positive is that it hasn't had sufficient resourcing and execution capacity. But if we have the resources to drive execution through cash, then we can address that. In emerging markets, one of the challenges for frontier infrastructure in emerging markets is that it lacks the stability and resilience of natural value and social license. So the large capex invested in these major projects have risk to guarantee residual cash flows and annuity cash flows in the medium to long term because of instability and risk. But if you invest in the stability around nature and public good, that provides more security for your social license, and we're demonstrating that in place and scaling that at the moment. So if anybody's interested to learn more about what we're building at NatCo and the Nat and trying to really address this from a systems lens, and again, I'm the world's worst entrepreneur because I don't really care how we get there. But what I do care about is that we address our relationship with nature and get enough cash to really drive at a landscape level and then at national levels and regional levels and global levels to really rethink that pyramid that Joseph showed is exactly how we're building all of this out, which is rethink how we think about the economy as not only the thing that we can extract from and throw waste in, which is nature, but as foundational core infrastructure that is the building blocks of everything else that we need. So we need to invest in it as well. So
Before jumping on to other questions, I just had one question for you, if I could, before wrapping up. I love the framing you put between the two companies, and it strikes me when we were talking about complexity earlier that one of the key missing parts is storytelling. Because when we look at the very complex nature of nature itself, and policymaking and different silos, and every single one is just flooded with detail, and the curation of what's important and how, with the other side of the activities you've done, not just because sort of the media industry and sort of advocating a message, but for the skill of storytelling, which is that missing component on how to convey complexity for the right reason. I'd love to hear more of your experience on bridging that the complexity and storytelling component that actually activates it for the right cross silo components.
well, that's a brilliant question, Joseph, and I'm not the right person to ask. So while I'm not a great entrepreneur, I'm an even worse communicator. So that's why I have partners, and that's why we build this out in partnership. what I will say around that is that one of the articles that came out in Forbes after we hosted the inaugural Nat Gala is about how the messenger matters. And it really struck me early in my career. I always thought that the glitz and glam and having celebrities say things, because it often comes out more simplified than, my science brain wants to hear it. I always thought that it was fluff and not necessary. But I'll give one example of just how necessary it is. At the eve of Climate Week, I've been to going to New York Climate Week for a decade plus, and there's a lot of similar actors around. The community is fairly small in sustainability, and you get to know people fairly quickly. We hosted the event on the Sunday before UNGA and New York Climate Week, so it's kind of like an opening event. And immediately after, I had messages from colleagues and friends that I knew in the community that said, "Oh, I heard you do this thing, and that's fantastic." And that would have happened any year. You have a nice event, people are drawn to, people know you, they're in the community, they hear about it. That didn't strike me as that different than anything else. So we had it Sunday night. By Tuesday, I had people coming to me, some of which I already knew, but many of which I didn't already know. And they said, not that they heard about this directly because of colleagues in New York during Climate Week, but they heard about the gala because their teenage daughter was following Billie Eilish on Instagram or TikTok. And Billie talked about it because Billie was giving Sylvia Earle an Ocean Heroes Award. And Billie didn't say anything sort of in depth around simplifying complexity or anything. She just said the oceans are cool. And she reached 12 million people. So all I'll say about the comms aspect is that the messenger really matters and how far we can get the message out. The message itself, it matters to a degree, I think. But what I'm finding out now is that the more people we can touch with the notion that nature is something that is cool, at least starts the conversations to get them engaged, so we can then explain more complexity over time. I think we've struggled a lot in our sector to try to get the message perfect, but it's not getting broadcast loudly enough across the people that need to hear it. So what I'm thinking about now much more is how do we get the message broadcasted and then refine it over time? Because the first step to integrate nature and culture and sustainability in culture is to make it cool. And then people will start listening, and then we can activate and grow the message to what it means and what they can do and how they can activate. And that's why we're building the NatCo and the advisory function and all the functions that we're building. It's all in a linear form to like galvanize the masses. Because this isn't a you and me problem, Joseph. This is an everybody problem. And the reality is that 95% of the population doesn't have any clue that nature is critical for their existence.
Yep.
So we're about an hour in. I know we typically end at 75 to 90 minutes, so we have a bit more time. There's a bunch of great people on the call that aren't putting their videos on, and maybe we can put some videos on and we can. But I'd love to hear from you just what's been drawn out in terms of the sessions before, what you've heard today, um, any additions that you have, any complaints about, our rambling back and forth, Joseph and I. I mean, anything at all. I just don't want to talk anymore. So,
I guess whilst waiting for any questions, if anyone wants to interject or contribute to the conversation, I'll maybe zoom back out in terms of what we're trying to put forward. And on one of the elements we both mentioned, which is how to actually catalyze not just the investments, but to catalyze the conversation of partnerships, not because it's formal partnerships, but because it's enablers that can feed off each other, not for a brainstorm, but because there's different capabilities available from different actors. I think it's one of those underestimated branding geniuses for the SDGs of sort of, it could be just 17 city colors, but if you've just got one color, as simple as that, and one element, you can actually go much deeper into the conversation across different silos. The complexity and jargon within the public sector, to governments, to science, to business, finance, and civil society, let alone media, allows that conversation where it's not just people thinking something's cool, but the other emotion that gets triggered, which is, hey, I can do something about this. And because I know what I'm doing, and I know my field, I can see why people haven't figured that let me get in here and contribute. The opportunity to contribute when on their own they can't do anything in that respect. And I think that's a very powerful element. We're creating that framework, and I think just on plastics, that's an example that we're extrapolating from that can apply to so many different areas in terms of just reorganizing the building blocks, where the incentive structures, the frameworks, and the pathway is there that invites other people to say, well, what can they contribute? So when we're speaking to corporates, it's not 280 multinationals on a business coalition that are there lobbying. It's 280 multinationals who are already ascribing to saying, we are looking for a solution to this one problem. And that's a massive ecosystem that no asset manager on their own could go and, with God knows how many marketing people can go and target and open. It's already curated in that respect. When you see the the science ecosystem, I remember sort of like at the UN Oceans Conference in Nice, and I never thought I'd end up at phytoplankton night. I was like the only investor person there, and end up in conversation with God knows more scientists realizing that phytoplankton is literally 40% of the oxygen we all have, and then extrapolating from that, how does that fit in with policymakers and how to, and just even the communication that you mentioned with the different. So when you're leading with a question on a specific technical element, you can go much further in terms of understanding the different enablers in different sectors. And I think the media aspect of things is a very powerful tool for that. But I'll land on that because I know that Caroline also has a question, and I'll let you respond as
Yeah,
well.
if I may, and Carolyn, I see you as well. But I just wanted to say one quick thing, which is I think it's a critical thing that to bring out is, what can we, all of us, do about it? And it reminds me, my son came home he's in junior high now. He came home last week and he said, there's this new teacher I'm going to have next year. And he was laughing because these students were asking her questions and she kept responding, that doesn't sound like a me problem. I think you can figure that out. I think broadly in society, when we think about nature and our relationship with it and all these things, most of us say, that's not a me problem. Someone else is going to figure that out. I think part of the communications that we need to have is that this is a we problem. This is an everybody problem, and we all have something to contribute and then give people the tools of how to engage. And I think that's a super powerful. Carolyn, you had your hand up. Really nice to see you. Love seeing fellow Canadian on the call. If we're at home, it's super early, so grateful for you joining at
Yes.
7 in the
Good
morning.
morning. And that is exactly why I am not on camera. Nobody wants to see me. It's a beautiful spring day here in Vancouver on Coast Salish territories. And thank you for the conversation. Um, I just wanted to pick up on something that I sort of felt like you actually both got to sort of at the crux and very tail end of your time speaking, which is the how. So the why is very clear, the call to action, the make it an everybody problem. I think many of us hopefully understand that. And then, especially at the very tail end, we were talking about this model where 1 million acres were going to activate and then underwrite risk for attracting additional private capital. Could you just go back to that and explain a little bit more? As an investor, that's exactly the kind of place I think we just need to get to is understanding the systemic lens and appreciating what draws us in, as well
Mm.
as the various international frameworks. But then I just wanted to go back to something. It's more of I wasn't quite clear. And I really did want to know because that's what we do here at the place that I work.
No, absolutely. And I'd love to have a longer conversation, Carolyn, specifically on that. And it's very timely, especially in the country that we're sitting in right now, given that Carney just made the nature commitment announcement 2 weeks ago. So so just briefly for this call, the way we think about it is that, landscapes and the global environment is a broad system. We can sort of drive commercial monetary gain and extraction from a portion of it. We just need to rethink kind of what that portion and prioritization of how to act on a landscape is. So very, very briefly, what we've consolidated and built under the NatCo is essentially a tech stack that allows us to look at any piece of land in the world, uh, look at its natural capital potential, and then look forward to what natural capital uplift can look like from a conservation and restoration perspective, and then price that from a cost side in terms of what conservation activities, restoration activities will be necessary for that nature uplift. We can also look and see if any of that is monetizable to then provide some revenue. The reality is in Conservation 1.0 and 2.0 that we've been living through is the majority of natural capital uplift activities, even if they provide revenue, don't provide enough revenue to generate a cash flow positive landscape. So the next step of the tech stack that we have is then looking to see in some proportion of that landscape, and this works in large landscapes. So I talked about 1,000,000 acres. If we can take sort of 10 to 20% of the landscape and think about commercial activities that don't compromise that natural capital uplift, but drive cash flows that allow for positive cash flow across the entirety of the 100% landscape, then we can start to build models that make sense for investors, capital-seeking investors. So that whole system has been applied in 1,000,000 acres in Southern Africa. It's on private land, so the tenure dynamics are different than in a place like Canada, where it's crown land and indigenous land. Though it is the same mentality is appropriate and can be applied. And we're extending this out to corporate lease land and then crown. We're talking with the PMO's office right now around how that can lead into sort of conversations with with the Canadian nature finance context. And on indigenous land. So the thesis and the principles can be applied on any landscape. So we have this pilot, but we also have partnerships with other jurisdictions where the dynamics are slightly different. The ways that cash is generated are slightly different, but this kind of 80/20, 90/10 model is still very, very alive and working. So I just joined a GP in India that's doing this in restoration, conservation, and commercial cash flows using an 80/20 model. We are supporting efforts in Europe, in the Western United States, in Latin America, in Australia, where nature markets are more robust, in the UK, where nature markets are more robust. And the fascinating thing is you can build from stable commodity cash flows and infrastructure, tourism, agriculture, and timber. But the evolution of regulatory policy in many jurisdictions is going to help regulate environmental cash flows as well from carbon and biodiversity and offsets and compensation, where we can start to stack these revenue streams to make really compelling 100% land use cases for a sustainable landscape solution. But I can go into much more detail individually with folks at some other point. But it's a step change from when I started in 2005 at Conservation International, thinking about how to deploy in landscapes from a return perspective. Audrey.
Thank you, Hari and Joseph. It's been a fantastic and very educational session. I'm just wondering if you could distill, both of you, one clear call to action here on the back of what we've discussed, not only in this session, but in the three prior. Because here we have those who deploy capital, those who deploy in its various forms, equity, grant debt, and stakeholder partners and implementers. What's the way to engage in your respective channels today? What's the one thing that people can do as a follow-up, very practically speaking?
Well, from my perspective, I think it's pretty clear we're launching this fund and so looking for different companies within that value chain. We're always on the lookout for those elements for investors, which are looking not just for the impact or the financial returns, but also that could be additive to how we scale in the right way, not just with the capital needs, but I guess one of the big core fractions, and I don't know if it's pretty much within this forum, but why we're designing it in such a way that it's not impact with some financial returns, but why the financial returns are arguably attractive, not just attractive enough, but have the potential to be above market, is because if we're also able to orchestrate the offtake agreements. So off-takers, and as Hari was saying earlier, that everyone's sitting there going, yeah, someone else can take care of this. that's the inertia that we're trying to that we see as the white space across the value chain. And all as big as the corporates may be, as much as they might put into their sustainability efforts genuinely, and within the CVCs in all of the different innovations they're hedging for or trying to promote, it's none of them on their own can fix the entire value chain on something niche that might be what the others are not thinking. But when coordinating and having the offtake agreements that they're at the table saying, okay, we'll catalyze this, and then we're just providing that value chain for them to for that trickle down. The returns take care of themselves, and then yes, the asset raising is something that's far easier when the catalyst is there because it's a sort of an inflection point. So yes, from us in terms of the call for action, I think it's clearly from the investment, but also the orchestrating the offtakes and the value add by and the going back to sort of the previous questions were like we're talking about the what and the how, but sort of like how are we getting there? It's all we're doing is it's effectively an orchestration effort where we're focused on one outcome allows us to unlock different approaches to different areas, which is saying, well, wait, that one question means that people can say, how do I solve it with my bid? And yeah, there's a lot of calls to action that just comes in for different contributions. But yes, right now we're
Yeah.
talking about.
Thanks, Joseph. Audrey, it's a brilliant question. I'm gonna distill it and try to simplify in some way. So I think about this as the human conveyor belt, right? So we're all somewhere on the conveyor belt from different stages. To me, the first stage is awareness that there's these challenges, the nature awareness piece is what I'm focused on, but awareness first, right? So exposure and awareness, I think, is the first piece that we're on. We're all on this call, so we're all aware at some point, right? So we're on the conveyor belt, which is a good start. The next step is activation. So what can I do about it? Is kind of the next. I'm aware, but then who cares? Like, what do I do, right? So the next step is activation. Um, Activation then leads to kind of strategy and what exactly can I do and how do I orient myself? Strategy leads to execution. So what am I actually doing to move forward? And execution then leads to, deployment in whatever way you can through resourcing your time, your effort, your money, your energy, your operating business, et cetera, et cetera. And then sort of ongoing evaluation, monitoring, making sure that you are achieving the things that you're trying to do for that change that you're trying to achieve. I think one place we often get stuck is, well, I want to do something, so just tell me what to do. But then you're not going along the conveyor belt. You're just asking someone else to give you the tool, and you make that investment and you're going to solve a problem. That's a challenge that we have. So my call to action for all of us is to say, to really, really think about where you are on the conveyor belt. Continue to engage so you can progress on that to get to the stage of execution, allocation, and change.
I'd love to pick up on that also, and I think Sarah had and great to see you, Sarah. Thanks for joining. If you'd like to jump in, or if I just read the question you have, I think it's a very interesting one, which I'd love to address. If you want to flesh it out, or should I just go straight into addressing it?
Happy to flesh it out. Thank you. So my question is on the how again, and I'd like to understand within the construct that you've explained, how you bring the necessary regulatory piece to ensure it supports or even accelerates the reconfiguration of the value chain to create the desired outcome. With all of that within the lifetime of a fund, unless this is also a parameter that you're changing in your customized capital stack.
Thanks so much for that question. It reminds me that maybe I wasn't very clear from the outset, but that is very much the trigger. That's the genesis of the thesis. So, but although I thought that your question was also touching on another very interesting point, which is the actual structure of VC and whether it's sort of evergreens and other innovations on the actual vehicles themselves, which is a separate point to the one that you're now making. So I'll address both. On the first point, in terms of policy tailwinds and catalysts, that effectively this is the crux of why we went in that direction. It's because we see that catalyst is there, and there's 3 or 4 of them. And I'll share a slide for that as I ramble on. The first is the financial catalyst from regulations that are there. So the corporate, so the CBAM is a massive one. Carbon border adjustment mechanism is. People knew about it, even in the sectors that were planned for January this year, which became legal. Even they were taken by surprise, and we see the fallout on steel, on fertilizers, where everyone's realizing. And for me, regulation is probably the biggest catalyst and biggest focus we've got. So thanks for bringing the question. And if I realize I probably wasn't putting enough emphasis on it. There's two types of regulation. There's regulations that manage perception, and there's regulations that manage reality. We're very used to the ones that manage perception, and unfortunately, maybe probably went too far in terms of causing a backlash, whether it's SFDR or ESRS, and every single way of slicing and dicing the way we report, measure, always focused on how things are perceived. But within that alphabet soup, we lose sight of the regulations that actually, within the small footnotes, fundamentally change entire supply chains and business models. Unfortunately, CS3D got diluted down, but for me, that was going to change capitalism on its own, and hopefully it will come back on the table. But CBAM is the other one. So if you're applying the European price of carbon to the carbon content of the 22 million tons of plastics being imported into Europe, which is half of the production, on our numbers and projecting on a stress test of what the carbon price on the regulated market, not the voluntary, will probably be by 2028, 2029, when you've got a short squeeze from all of the exporters hedging their forward sort of liabilities as they did within
I
Europe.
think, Joseph, apologies to interrupt you. I think my question is not on the existing regulatory framework, but more if we're taking a more generic approach and we try to replicate the suggested approach you have for us to create an entire customized solution, talents, capital for a desired outcome. How do you include the regulatory piece in general, which is what it is when you start and fundraise for your fund, and that is going to evolve over time?
That's a great question. If I may, Joseph. So, Sarah, I think it's a fantastic question. And some of the pressures from an investor lens is the regulatory provisions and future looking to see where regulations are going to go. So here's where I'll come back to what is it that we can do? And thinking systemically, in my mind, is thinking about all of these things as tools or arrows in the quiver of how we can engage. So my philosophy on this is that it's another tool set that we can use to drive the regulatory change needed. So in my example, when we think about nature as a new asset class, one of the things that we did was create, alongside Conservation International, a recipe for subnational and national jurisdictions to install policies. What policies would be necessary and regulatory functions would be necessary to build high integrity nature asset classes. And we presented that at the Convention on Biodiversity in Cali, Colombia, and we had broad uptick, and it drove sort of regulatory change it's driving regulatory change in various jurisdictions. So I think one of the things that we can think about is, we have a core skill set, and maybe we're investors, maybe we're operators, maybe we're something else, but to use that skill set in other avenues, and those will be supportive for you going forward in your investment strategy. So how can you help drive the regulations necessary for the systemic change to happen? Or who can you partner with and be associated with that can help drive some of those things as well? Another quick example I'll give is, early in our consulting work, we worked in Chile. And Chile had a challenge, and most jurisdictions around the world have a challenge around land. Private land in most jurisdictions around the world cannot be held for conservation purposes uniquely. There's no real right of conservation in most civil code countries. What we did in that case, because private land was majority of land in Chile is private, and the risk is expropriation risk, where if you're not productively using land in most jurisdictions around the world, governments can take it away from you. And the pushback was there's many private landholders that wanted to maintain the Mediterranean habitat, which is critical for biodiversity in Chile, but they weren't recognized. That wasn't recognized as a real right of holding that land. So what we did was engaged with the government and senators to drive a policy change, not only a policy change, but a constitutional change, where the rights of landholding were changed to allow conservation to be a real right. And that's been looked at from other similar legal structured countries to drive change on the regulatory side. So there are ways to do this. And, I didn't go into working in Chile on a private land deal in Valdivia thinking that we were going to have constitutional change as part of our mandate. But sometimes it's necessary to drive what we need to do. And at the end of the day, regulatory change and policy functions need to change across the board, because if you remember what I talked about, the $700 billion nature funding gap, 2/3 of that is due to the fact that most policies are perverse and promote and incentivize extraction, which undermines the resilience of the natural capital economy that we build everything upon. So I think it's just thinking a little bit more laterally about how we can influence the regulations to drive towards those solutions and the goals which we talked about. If it's goal oriented, then investment, operations, regulation, philanthropy, all of these things are pathways to get to the solution that we need.
I fully agree with that. And in fact, if I address the question in terms of the other direction as Harry is, in terms of how this affects policy, not just gets catalyzed by it, that's effectively and I'll put some meat on the bone with this. A lot of the policy, and taking a consultant hat when you're advising policymakers in terms of this is what's needed, you need that symbiotic relationship. So looking at the very tangible, practical, okay, how do we build this value chain? What's needed? That informs what type of policy is needed. And when we look at the plastics treaty in particular, it may have stalled and it never got to the stage of, okay, well, what are the alternatives and how do we get there? Because they wouldn't know that it exists because it didn't get to the stage of how do we address it. Whereas if we're able to say, well, here's a potential solution that is financially viable, that then goes and drives back up to the tilts needed for policy. And we've been in so many of the different discussions where that's the light bulb moment saying, actually, if we orchestrate it this way, that is what informs the way that the policy needs to be calibrated or adjusted. So whether it's the global trade, so with WTO in terms of how they're lobbying for policy for food security, for food safety standards, because, well, if you're going to use seaweed for packaging, you kind of need global food safety standards. So how that two-way relationship, because once you've designed what the solution needs to be on a systemic basis and how to get there, that informs the bits of the policy that needs to be adapted on a systemic basis. Because if they're just doing if policy is only based on feedback from corporates in their own silo and not in terms of how do we reorchestrate value chains, policy is always going to be, it's not going to be fit for purpose, as we've seen. So that symbiotic relationship is very critical, not just because it sort of catalyzes the way business changes, but then how the solutions actually inform the opportunity for policy to unlock things.
Thanks so much. I think we're coming on time, Kevin. I'll let you wrap up. But I just want to say one thing, which is thank you so much, Joseph. It's been really a pleasure being on these calls and facilitating alongside you for the last 4 sessions. A big thank you to Kevin and Audrey for inviting us here. It's been a lot of fun. And a huge thank you to everyone that's joined and still with us. We've had, I think, good participation throughout the series. Love to continue conversations as and when people would like. And yeah, just a lot of gratitude for being able to be here and everyone taking time out of their Friday mornings at breakfast to join us. And Kevin, over to you.
Real pleasure, Hari. Joe, thank you both so much. It's been a journey and we do appreciate it. We got to give everybody a role in this. Nature is cool. That's a role. That's a role for a teenager, right? And behind it has to be something predictable that we all have faith in. And that's all the vehicles that you guys are talking about. That it's not just recycling and that's the way we intersect with nature conservation. And then we have doubts about recycling and its impacts. It ultimately comes down to we all have to make a sincere effort because we believe and connect with nature as a fundamental. We come from nature, we rely on nature, we will rely on nature. So I really do appreciate it. Thank you. We will follow up with a thank you note with an invitation to reconnect with Hari and Joe, with a video link to not just our channel, but to the individual sessions, should you want to follow up. And also, we encourage you to please reach out and continue this conversation, either with our panelists throughout the series or with us if we can facilitate any future engagements. Thank you all so much for this. We do appreciate it. Thank you.